Welcome to vTalkInsight, Risk Sentiment Daily for January 28, 2026. Global markets are wrestling with a powerful mix of AI-driven growth, a weaker dollar, and rising concerns that inflation and policy uncertainty could upset the party. Over the next few minutes, we will explore how this tension is shaping risk appetite across equities, credit, and currencies, and what the current balance of forces suggests about today's cautiously risk-on mood. Across risk assets, the tone today is cautiously risk-on. U.S. equities are grinding higher with the S&P 500 up again and volatility gauges sitting in the mid-teens, signaling steady but not euphoric risk-taking. That lines up with recent sessions, where investors have been comfortable adding exposure to growth and AI themes, yet remain very aware that the macro and policy backdrop can shift quickly. Behind the headline indices, positioning looks selective rather than broad-based. AI-heavy markets such as Korea and mega-cap tech in the U.S. remain key engines of performance, while earnings beats from large corporates help to justify current levels. At the same time, safe haven demand is visible. Gold is making fresh highs, precious metals are attracting strong inflows, and the cost of hedging dollar downside has risen to levels not seen in more than a decade, all pointing to meaningful demand for protection. The result is an environment where growth and earnings support risk assets, but hedging activity and cross-asset stress indicators argue for ongoing caution. Investors are watching upcoming inflation prints, the Federal Reserve decision, and policy headlines for confirmation that the soft landing narrative can hold. Any disappointment on those fronts could quickly test this fragile, but still constructive sentiment. AI capex and tech-led growth remain the single strongest bullish force in markets today. Fixed income and equity teams alike are building in slightly above consensus U.S. growth, helped by a powerful investment cycle in semiconductors, data centers, power infrastructure, and connectivity that is tied directly to AI demand. Mega-cap technology firms are planning and funding huge capital expenditure programs, yet still expect to generate substantial free cash flow, reinforcing confidence in the durability of this theme. Immediate earnings benefits are most visible in the AI infrastructure stack. Chip makers like Micron expanding capacity, optical fiber suppliers signing multi-year deals with big platforms, and cloud providers launching in-house AI chips to compete for share. Equity markets from the S&P 500 to Korea's tech complex are increasingly driven by this narrative, which helps explain why indices can push toward record highs despite late cycle worries elsewhere. That said, investors are scrutinizing whether this heavy spending is funded from operating cash flow and how quickly it converts into earnings. Upcoming results from major AI-linked firms will be critical tests of whether the growth story can keep justifying rich valuations and concentrated leadership. Robust global growth and fiscal support provide another key pillar for risk appetite. U.S. GDP is running near the 3 to 4% range, while internal forecasts for next year sit modestly above consensus around 2.5%, suggesting a backdrop of decent, if moderating, expansion. Fiscal expansion remains an important driver, from U.S. industrial policy across the AI supply chain to targeted subsidies in areas like electric vehicles. New trade agreements, such as the EU-India deal and broader diversification away from single-country dependencies, are also supporting activity, with copper and other base metals rallying as major economies secure critical minerals. However, the growth story is uneven. Consumer confidence has weakened, perceptions of the labor market are softening, and wage growth for many households is barely ahead of inflation, creating a K-shaped dynamic between strong corporate balance sheets and pressured consumers. For markets, that means earnings and cyclicals can still find support, but there is less margin for error if fiscal support fades or if labor softness starts to feed more visibly into spending and sentiment. Weaker dollar supporting international and EM assets is a third important bullish driver. The broad dollar index has slipped to its lowest level since early February 1, 2022, and this depreciation is feeding directly into stronger performance for currencies like the euro, pound, and Swiss franc, as well as a range of emerging market units. This currency backdrop is helping push exchange-traded funds tracking France, Germany, Japan, and key emerging markets such as Brazil to fresh or near record highs. International equities are still trading at sizable discounts to U.S. peers, and the combination of cheaper valuations and a softer dollar is creating a meaningful tailwind for non-U.S. risk assets. Even so, foreign exchange markets are far from tranquil. The cost of hedging further dollar weakness is at its highest since 2011, and expectations of coordinated interventions, particularly involving the yen, are adding to volatility. If U.S. growth or labor data were to deteriorate sharply, or if there were a major equity drawdown, safe haven demand for the dollar could resurface quickly, challenging this supportive backdrop for international and emerging markets. On the risk side, sticky inflation and renewed tightening fears are front of mind. After a period of goods price disinflation, rising tariffs and supply-side frictions are pushing goods prices higher again, and several observers expect inflation to stay above roughly 2.5% through year-end. Tariff-related cost pressures are now expected to intensify in the first half of the year as companies pass more of these costs to consumers, adding to already elevated energy and natural gas prices after back-to-back colder than normal winters. There is also concern that personal consumption expenditure inflation for December could print above 3%, which would draw renewed attention from the Federal Reserve and challenge market hopes for multiple rate cuts. Bond markets are highly sensitive to this narrative. A reversal higher in the 2-year Treasury yield would signal expectations for stickier inflation or fewer cuts, and that kind of move has been flagged as a material risk for risk assets if financial conditions were to tighten again. While some softer labor indicators support the case for 1 or 2 cuts later this year, the balance of evidence today points to a higher for longer bias that could expose the most valued parts of equity and credit markets. U.S. policy and shutdown risks are another important source of uncertainty. Market-implied odds of at least a partial government shutdown have risen meaningfully, with the Department of Homeland Security-focused closure now seen as quite likely, even if the direct hit to growth is expected to be small. The larger concern is that a shutdown could generate another data drought, disrupting key labor and inflation releases just as the Federal Reserve is reassessing its policy path. That would make the upcoming Fed press conference and any shifts in forward guidance even more market-sensitive than the rate decision itself. Beyond the funding debate, uncertainty around the next Fed chair, political frictions over immigration, and sudden policy moves such as flat reimbursement for Medicare insurers are reminders that U.S. policy can move markets abruptly. Tariff threats have had mixed follow-through so far, which has encouraged some investor skepticism, but together these factors still argue for a higher risk premium around U.S. policy and for elevated event-driven volatility. Elevated valuations and credit spread risks round out the key bearish drivers. Across asset classes, pricing looks stretched. U.S. equities trade at sizable premia to history and to non-U.S. markets, and there is growing concern that future returns will need to come much more from earnings growth than from further multiple expansion. In credit, investment-grade issuance is on track to exceed $2 trillion this year, with net supply rising by several hundred billion, even as spreads sit near multi-decade tights. At the same time, losses on asset-backed private credit deals, which were considered relatively defensive, are flashing warning signs about broader private credit exposures, especially for insurance companies and alternative managers. Safe haven flows reinforce the sense of late-cycle fragility. Central bank and investor demand has helped push gold to consecutive record highs. Silver has seen extreme intraday swings, and worries about foreign selling have made equities look more vulnerable than treasuries. Taken together, tight spreads, rich valuations, and pockets of stress suggest that any shock from inflation, policy, or growth could trigger a sharper repricing than headline indices currently imply. To sum up, risk sentiment today is cautiously risk-on. AI capex and tech-led growth, solid global activity, and a weaker dollar are supporting equities and international assets, even as inflation risks, U.S. policy uncertainty, and stretched valuations keep hedging demand elevated. The balance between these bullish and bearish forces is delicate, so the next legs of inflation data, the Federal Reserve's messaging, and developments around U.S. fiscal and regulatory policy will be critical for how portfolios absorb risk over the coming weeks. This video is for information only and is not investment advice. Visit and subscribe to vTalkInsight.com for latest interactive market insights.